Good morning and welcome to this Wednesday, February 15th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Before we get started today, I do want to just give everybody a shout out on YouTube. We have now gone live on YouTube. We're streaming. So just want to make sure that we reach out and recognize all of you that are joining us on this stream. We certainly appreciate it. Make sure you pass it on to your friends. Love to have our community here grow at Earnings Beats. Taking a look at the futures. It's been kind of a wild ride a little bit. Futures were down overnight. We've seen a little bit of craziness, volatility this morning based on a really strong retail sales number that came out. So you're going to have those looking at the number thinking, well, higher interest rates, potentially higher inflation. And then you've got the other side saying, hey, what about this big recession we were supposed to be having? Retail sales coming in pretty hot suggests that the consumer is still quite alive and kicking. So a little bit of a difference there, I guess, depending on whether you see the glass as half full or half empty. It really depends on how you look at it. But currently, we've got futures. Well, I'll tell you what, let me look at I'll give you what the ETFs are trading in pre-market, because the futures I'm looking at are on delay. So right now, the diamonds, which track the Dow Jones, they're down 0.4%. The Spider, which tracks the S&P 500, down 0.4%, and the QQQ, which tracks the NASDAQ 100, down about 1/3%, 0.34% right now. So we are looking at slightly lower futures. Again, mostly overnight, we were lower. Then we bounced back, looked like things were definitely going to improve. We're going to start off green, then they kind of swung back and forth. But right now they are down as we approach the market open. So in less than 30 minutes, we'll be opening. And it does look like right now we'll get off to a slightly weaker start. All right, I'm going to show you, well, for those of you who are new, especially those of you joining us on YouTube this morning, again, want to really give everybody there a shout out. Appreciate you tuning in. If you go over to earningsbeats.com, that's our home. You can scroll down. There is a free newsletter. We'd encourage you to sign up if you want to learn more about what we do at Earnings Beats. There's no credit card required. You can unsubscribe at any time. It only takes name and email address. Hit that subscribe button. We'll get you set up. This is a newsletter that's published 3 times a week, Mondays, Wednesdays, Fridays. Normally out by about 8:30 in the morning. I can tell you this morning's will be a little bit delayed. Just personal issue there, but it should be out later this morning. But normally you'll be getting it right at about 8:30 in the morning. That's what we strive for. Things that we focus on there, as our name would imply, Earnings Beats, we're really into the focusing on fundamentals, obviously technicals as well, but fundamentals for sure. So we do look a lot at earnings reactions, gaps, relative strength is important for us. So we talk a lot about relative strength. You'll see a little bit of that this morning. Candlesticks, price volume, moving averages, trend lines, momentum indicators like the PPO. Some of you might use the MACD. PPO and MACD are really almost interchangeable. The RSI we'll talk about sometimes, accumulation distribution, those types of things. So anyway, if you want to sign up, learn more about what we do and how we approach the market, this is the best way to get to know us. Sign up for that EB Digest. All right, let's take a look at the major indices and sectors from yesterday, Tuesday. Saw the Dow Jones Industrial Average yesterday drop 157 points. S&P 500 down 1 point. NASDAQ up 68. So we had bifurcation here. Had the Dow going down, S&P flat, NASDAQ moving up. That's been a theme in 2023. And after a brief period of the NASDAQ underperforming, it might be that we're getting ready to take off again on the NASDAQ on a relative basis. We shall see. Mid caps up 1 point, small caps down 4. So again, bifurcation, little up, little down yesterday. Really not too much action though from the prior day. We didn't really finish too far from the prior day's close. Discretionary and technology, the two primary leaders, especially discretionary. Tesla with another big day yesterday, despite having a lot of in-the-money call premium. But the volume on Tesla has been very heavy, and it's hard for market makers to get control of the action going into option expiration Friday when there's so much volume on the stock. Yesterday was a good day on Tesla. Tesla, the second largest component of the XLY, trailing only Amazon. And as a result, when you get a big day on a stock like Tesla, generally you're going to have a good day on discretionary. And that's what we saw yesterday. Technology up about 0.4%. Really just sitting in a bull flag. I mean, beautiful move up, nice uptrend since the first week of January. And just look at this sideways action. I mean, that's almost a perfect flag off of a flag pole that normally resolves itself to the upside. We will see. To the downside, watch the rising 20-day moving average, which is also right about where we broke out above that earlier December high. So broken price resistance becomes support. That's technical analysis 101, really. There was your breakout above 139 or so. We've gone back down. We've tested 139. The rising 20-day moving average right now is at 138. So that's an area to watch. Technology is the largest sector, has the biggest representation within the S&P 500, within the NASDAQ. And so this is one of the most critical sectors to watch. If you're just simply worried about what the NASDAQ does or what the S&P 500 does, this is your leader. This is the group that you want to see leading if you're bullish, and obviously the opposite if you're bearish. Right now, though, technology performing really well. To the downside yesterday, most of the weakness was centered in and around defensive areas, real estate, consumer staples, healthcare. These are all groups that typically lag during bull markets, not bear markets. So to see discretionary and technology lead again, which is two of the primary aggressive sectors, and then seeing three defensive groups lag, that's pretty good under the surface action yesterday. It's just one day, but it's kind of picking back up with what we saw in January and into early February. So that will be worth watching, especially with the news coming out. We've had a very, very slow week so far in terms of economic news, but that is all changing as we take a look at the 10-year Treasury yield here, which currently is at 3.77%. I think we got 3.90 in our sights, and then it's just a matter of whether we go through that level. But you can see we are up a little more than 1 basis point today. Hold on one second. So here's the economic news out today. January retail sales. The actual number, we saw a rise of 3%. That's a big, big number. I'm not saying 0.3%. I'm saying 3%. Huge. The expectation was big. The expectation was 1.7%. But January retail sales blew it out of the water. I have not seen the report. I haven't really seen any talk about what caused it. My guess is that the weather in the Northeast has been very mild, really all up and down the East Coast for the most part. So my guess is January retail sales had a positive impact just because weather was so much nicer than normal. That would be one reason. Of course, if that's the reason, then we'll probably see it tail off in February a little bit. We'll see. December, by the way, was minus 1.1%. And if you remember, on the East Coast, we had that huge cold spell right around Christmas time, just before Christmas. So maybe the weather had an influence. I don't know. Again, I haven't really looked into it, but that would be one possible explanation. If we strip out the autos, January retail sales rose 2.3%, still way above the expectations, which were for a rise of 0.7%. And December was revised a bit better from minus 1.1% to minus 0.9%. February Empire State Manufacturing Index. If you remember, January was minus 32.9. February was expected to improve to minus 18.5. Well, it really improved. It was minus 5.8. So a huge improvement in that index. Coming up later this week, Again, hardly any economic reports so far before today. Today, some big ones. Tomorrow, we've got, later today, we've got industrial production, capacity utilization, December business inventories, and February housing market index. All of that coming out later today. Then tomorrow, we've got housing starts, building permits, jobless claims, Philadelphia Fed manufacturing index, and just to throw one more thing in there, how about another inflation report? We got the January PPI coming out tomorrow. So there's a ton of economic news that the market's going to be dealing with. And I think it'll be interesting to watch the bond market more so than the stock market. Bond market gives us a lot of clues. And we are trending higher in the very short term here with the 10-year Treasury yield now back up close to 3.80, 3.80%. We're at 3.77 this morning. 3.90, here's that level right at the end of December. And we've got on both sides of this top, you can see a double bottom, 340, 337. Usually when you have a double bottom, that high in between is a key area of resistance, technically. So that's why when we bottomed at 337 here, essentially that double bottom, and started moving up, I said 390 is the level we have to watch. I'm not really worried about the moving averages because in a trendless sideways market, the moving averages really don't matter. We usually go right up and down through moving averages like a hot knife through butter. Now, when you're trending, you've got a really nice trend in play. You come down, those moving average can give you great support. And on the way down, a lot of times you bounce up and you hit resistance at the moving average. But once you get into a period of sideways consolidation, that's when the moving averages, it's a little bit of chaos just in the near term. So I'm much more interested. Do we go through 390? If we do, then I think this longer term uptrend in interest rates remains in play. And if you're looking from a bearish perspective on the U.S. stock market, that would be one thing that I would put a check mark in the bears column if we go back up through 390. I'm not saying that's going to send us back down because, again, the stock market's going to look out 6 to 9 months. It's not really worried about right now, but a breakout there would be something to at least take notice of. To the downside, if we break below 337, ultimately, I think that would be a very, very good sign for the stock market, especially those high growth areas of the market where lower interest rates can send valuations soaring. So let's keep an eye on the bond market. That's always a big part of what we do here at Earnings Beats. All right, moving on, let's take a look at the S&P 500. Not a whole lot yesterday. We saw some volatility. We were down as low as 4,095, as high as 4,159. So that was about a 64-point range. That's 1.5% of the S&P 500. So we had a little bit of volatility, but we did finish right in the middle, still well above the 20-day moving average, still in this uptrend. I don't see anything technically about this short-term uptrend that would bother me. Hold on, I'm just going to grab a little water here. Looking at the NASDAQ 100, pretty similar, except we did close more closer to the high. Remember, I said at the opening, the NASDAQ, it was a bifurcated market, but the NASDAQ was showing some leadership. We closed almost on the highs yesterday, and we were down a little bit during the day, but we came rallying back for the second straight day, higher highs, higher lows. So if we finish, or if we start the day today down, one question is, do we continue this short-term trend of higher highs and higher lows? Do we hold the low from yesterday on the NASDAQ, which was 12,356? That'll be one thing that I'll be looking at personally. Because as long as we stay in this uptrend and we're above the rising 20, which is now above the rising 50, this right here is bullish configuration. I know there's a lot of folks saying, yeah, but we're still in this downtrend. Well, technically, if you go by the theory of lower lows, lower high, lower low, lower high, lower low, lower high, hey, you're right. We are still in this series. But if we take a look at the weekly, you will see that there have been some serious changes. The trend line's been broken. Previously, when we've gone up and we've tested or just moved above the 20-week moving average, we have quickly sold back off and gone to new lows. Here we go up just above the 20, pull back, hold the prior low, and break out again above this high, above the 50-week moving average, which we have not seen, and check out the PPO, which is now weekly PPO, literally right on the center line. And as we were moving lower prices, check out the PPO, higher lows. That's a positive divergence. Many times that will mark a very significant bottom. So I've been saying this for a while now. If you're short, if you're bearish, be open to the possibilities that this is the start or the resumption of the long-term secular bull market. I have called since the very beginning, since the beginning of 2022, before we even started going lower, I said we could be looking at a cyclical bear market in 2022. There were just a lot of signs. You can see the higher prices here with the lower weekly PPO, negative divergence. All the money in December, when the market was trying to go up higher, was shifting to defensive areas. Wall Street was preparing for something. That's the beauty of following the market underneath the surface. I know, it's a cheerleading session on CNBC when you're setting new all-time highs, but you've got to be smarter than that. You've got to look beyond what they're talking about. You've got to check to see what's going on in the market. We had a lot. Sentiment was crazy bullish, ridiculously bullish, like by far the most bullish I've ever seen at the end of 2021. When you get to that level, everybody's bought in. Everybody who can buy has bought. Wall Street moving into defensive groups, negative divergences everywhere. The signs were there. And what I said at the beginning of 2022 was we could fall 20 to 25%. I gave a worst case target. Let's go back to that S&P 500. Gave a worst price target early in January of 3,500 to 3,800. We went down here, 36 was the low. I thought that's when I called the bottom. I thought that was it. We had a big move up. Then the Jackson Hole speech with the Fed. We ended up moving down one more time. There was some distribution in here too, by the way. But we went in, put in that final low. Where was that final low? 34.91. 9 points below the low of the range that I'd provided 9-10 months earlier. Here's another interesting fact. If you're new to the market, if you're new to us at Earnings Beats, there have been 14 different bear markets since 1950. 14. If this turns out to be the low in this bear market, which I believe it is, it will mark the 7th time that October has marked the low of a bear market. That's more than just a coincidence. 14 bear markets, there are 12 different calendar months. 7 of the 14 bear markets have ended in the same calendar month. We talk about this all the time. The best time to be in the stock market is the 4th quarter. The end of October through the early part of January is the best time for the stock market. It's not the only time it goes up, but it is historically the best time. And so when everyone kept saying we're going to go lower in October, I'm thinking, and let me give you a stat, and then we'll move on to some other things here. This is a really interesting stat. From the close on October 27th to the close on January 18th, which is a little less than 3 months, the S&P 500 from the start of the period to the end of the period had gone up 62 of the last 71 years prior to this last year. So we just made it 63 out of 72. That's about 86% of the time the S&P 500 moves up from October 27th to January 18th. Now, if you want me to take on that bear argument, I mean, forget about everything else. There were a lot of other signals that I thought were turning much more bullish too. But if we just ignore everything else, 86% of the time, we go higher in the 4th quarter and into the early part of the 1st quarter of the next year. It's not the time to be thinking overly bearish thoughts. CNBC will have you thinking them. The media in general will have you thinking them. Folks, we were at 4,800. We went to 3,591. It was one of the worst bear markets we've had. And yet, the majority of folks think that it's going to be the Great Depression. Stop thinking like that. Let me show you, I'll show you one other chart. I promise we're going to get on some other stuff here. Here's the long-term 100-year chart of the S&P 500. There's the left side. This is over 1932 right here at that low. Here's where we are now. Looking back for the last 90 years, do you think it's been better to be bullish or bearish most of the time? I mean, this move right here, if you go back, most cyclical bear markets, here's one, early 80s. Here's one, 1987. Here's one, 1990. That was the Persian Gulf War. Of course, 87 was the crash. Here was one in 98. We were down 20%. If you go back during the 1950s and 60s, during this huge bull market run, we had bear markets starting in 56, 59, 62, 66. These are normal. Bear market we had back in 2018, right there. Trade war. Then we had the pandemic. Now we've got, the 2022, call it whatever you want. Inflation surge. The war. Surging oil prices. Higher interest rates. Every one of these other ones had many of those things too. Everything's not always perfect, but the stock market most of the time climbs the wall of worry. You're going to be much better off in the long term when the market goes down 20 or 25%, thinking buy. Gets back to what Warren Buffett's always talked about. Be fearful when others are greedy. That was the end of 2021. Be greedy when the others are fearful. That was the pandemic. That was this year, 2022. Well, last year. Anyway, let's keep moving. So home builders. So this morning we got a report out that mortgage rates had gone up. Wow. Okay. That is a shocker if you follow the 10-year Treasury yield, which pretty much, the direction of the 10-year Treasury yield pretty much mirrors the direction of mortgage rates. And the 10-year Treasury yield's been rising, so it shouldn't be any shock. But mortgage applications dropped. I think it was like 7% or 8% last week as a result. And that's to be expected. Now, what I look at is not the news, but what I look at are the charts. And home builders, here you can see home builders have had a steady move up November, December, January, and into February. And I want to show you something on home builders. We'll come back to this chart in a second. But I'm going to pull up seasonality for home builders. I'm going to go back the last 20 years. And I want you to look at the best months over the last 20 years for home construction. This makes no common sense. Well, it does if you think about it, but let's look at the numbers first. November, the Dow Jones U.S. Home Construction Index has gone up an average of 3% during the month of November over the last 20 years. An average of 3.4% over the month of, or during the month of December over the last 20 years, and 3.8% during the month of January over the last 20 years. And during November, home construction's gone up 80% of November's, 70% of December's, and 70% of January's. And when you compare it to all the rest of the year, these are the three best months of the year consecutively, right in the middle of winter. November, December, January. Who would have thought home construction does well then? That doesn't make sense. That's the slow time. Construction kind of comes to an end, comes to a halt, especially in the Northeast. Start getting snowstorms, and there's not a whole lot of building going on. But this makes perfect sense when you think about the stock market looks 6 to 9 months ahead. So starting in October into November, we're looking into the springtime. So folks that are buying in based on what they expect is going to happen in 6 months. So let's go back to that chart. If home builders are expecting, if Wall Street, the big Wall Street firms are moving their money into home construction because they like what they see in this industry in 6 to 9 months, what does that tell you about the direction, the likely direction of interest rates later this year? You think rates are just going to keep going up? If Wall Street believed rates were just going to keep going up, we're going to keep fighting inflation and mortgage rates were going to go through the roof, would you be buying home construction stocks? My answer is heck no. That'd be the last thing I'd want to do. This is a clue. Whether you look at it or accept it or agree with it, it's completely up to you. But I look at the way certain things in the market are trading relative to one another. I got a lot of inspiration from John Murphy, who's an author. He was on CNBC for 7 years. He was their technical analyst. He writes at Stock Charts. I've met John. He's a really good guy, very, very smart guy. And some of his books that he has written have been, and I don't read a lot. I don't like to get too much noise in my head. I like to do my own research. I like to feel like, my news is the only news I need for the most part. So I don't really try to get too many outside influences. John Murphy's an exception. He was the one that first brought up this idea, first time I ever thought about it anyway, of intermarket relationships, intermarket analysis. And I'd like to think I've taken his work and taken it to another level. That's what I try to do in my research. I love intermarket analysis. I think it tells us so much about the stock market that you're never going to hear on CNBC. They're not going to try and educate you. Think about what CNBC does. Think about Wall Street, the big firms, what they do. It's the biggest conflict in the history of conflicts. You've got big Wall Street firms that are buying stocks for themselves and for their very, very, very wealthy clients. That's 1/3 of what they do. They also have analysts that go out and meet with the firms to find out, okay, how are you all doing relative to your competition and so forth. They've got these analysts going on CNBC telling you and me to buy or sell based on what they're seeing. And then they've got a market making unit that's doing the opposite of what everyone's doing. So if they're telling you to buy and everybody goes and buys, they got market maker back at their office that is committing their capital to sell to you. Is that not a conflict of interest? They're managing money for the wealthy. They're going on CNBC telling folks what to do, and then they're doing the opposite with their firm. I mean, I've been a proponent for many, many years of an independent market maker. I think market making should be independent. I don't think it should be with these big firms, Goldman Sachs, who gets to go on CNBC and tell you what to do, and then they get to do the opposite. I mean, listen, it's the way the system works. It's legal, but it's not right. And yet it still happens. The best way to understand the stock market, because nobody understands the stock market listening to CNBC. You'll never understand it. Because all they're doing is, okay, this report came out, that's why the market's up. Oh, next day it went down. Well, forget about that report. We had something else come out today. That's why the market's down. Just look at the big picture, look at where the money's going, and you'll be able to predict the market so much better than ever. Anyway, there's your home building group doing very well. Look at the relative strength. Home builders bottomed relative to the S&P 500 all the way back in April. It's been going up now for 10 months. Relative, that's the rotation. That's that intermarket relationship. Home builders, you want to call this a bear market and a recession coming? Go ahead, but Wall Street's moving into home building stocks. Good luck with that recession. Just again, not that I'm a genius with the economic side of things. I'm just following what Wall Street's doing with their money. Retail report came out really strong today. Check out what retail's been doing. Got this big recession coming, right? Well, why did retail bottom on a relative basis to the S&P 500 back in May? Think about it. Why? Why is money rotating into retail for the last 8 or 9 months? Probably because the market's not anticipating this recession that everybody's talking about. Certainly not a deep one. All right, just a couple earnings real quick. We had Airbnb report last night, and the market is just now opening. So we will take a look at the real-time charts, but wanted to just show you Airbnb. Let's get the real-time. It was up 10. There you can see that was right around the time we started the show. And the market has opened. It's up 11 right now. So let's go ahead and pull up the charts. I'll try to wrap this up here in the next couple minutes. I know everybody's anxious to get to their thing, get to their own trading platform, whatever. Here, Airbnb breaking out above all these prior highs. That's a great reaction. I love that gap up today. We could see short-term move to the downside, but I really like Airbnb going forward. Devon Energy, DVN. This is in the energy space. Been getting some energy reports and reactions that have not been so great. I'm beginning to think maybe some of these have made their run. Let's see, what else do we have? GoDaddy reported last night. And GoDaddy, you can see up about 1.4%. Akamai Technologies also reported. There's a big gap down there. And this is a stock that just has not been performing really very well at all. So I'm not too surprised by the weak response. Let's see. This morning, we had Analog Devices that reported. So ADI, big gap up there. This is in your semiconductor space. That one looks good. How about Kraft Heinz? More of a staple. Not really doing much with its earnings. Biogen IDEC, or at least used to be IDEC, Biogen Inc. Not really much of a reaction this morning from its earnings. And let's see if there's any. Let's just go ahead and end it there. I will say later tonight, you got Cisco Systems reporting after the bell. Shopify, that was a name that was really hot back in the day, a couple years ago. Kind of weakened. It's starting to strengthen again, though. Don't be surprised to see a good surprise out of Shopify later. We'll find out. Anyway, I'm going to go ahead and wrap up with that. Let's just get a quick update on the market, and I'll let everybody go here. Dow Jones down 156, S&P down 18, NASDAQ down 33 on a percentage basis, NASDAQ down. Also, check out that VIX. The VIX had a big down day yesterday, and I think it was because we got beyond the inflation report. That's generated a lot of volatility in 2022. The VIX shot up a little bit heading into that report. Right, that means the options were being priced a lot higher heading in because market makers wanted to be protected from potential volatility. But now that that CPI report is in our rear view mirror, we're seeing that VIX drop back down again. I can tell you this, those of you that are clinging to bear market, there has never been a bear market when the VIX drops below 16, 17, that range. So keep an eye on it. It's 1871 right now. Anyway, have a great day, everybody. I'll be back tomorrow over at Stock Charts TV, 9 a.m. for the next Trading Places Live. Right here at Earnings Beats. I'll be back next week. And I also want to mention we have a huge event tomorrow. We are doing what I call our stock market draft, our stock portfolio draft. We have 3 portfolios. All of them, we're going to be choosing the 10 equal weighted stocks that go into each portfolio. And if you haven't seen our performance, we have crushed the S&P 500 since we started doing this back in 2018. Our model portfolio is up like 100 and I don't remember what the number is at this point, 130%, 135%. S&P is up like 50%. We're up like 2.4 or maybe 2.6 times what the S&P 500 has done. Tomorrow night, we'll unveil our stocks for the next 90 days. So if you haven't already signed up, go to Earnings Beats. You can have a no-cost 30-day trial. 30 days, zero cost. You do have to give credit card for this one. And we'll let you know before your 30 days expires so you can decide if you want to continue. Anyway, that's it for me. Have a great day, everybody. Happy trading.